Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing. This is Aaron Edwards, Santos Springs. It is June 10th and we have a lot to cover. For several weeks, no action recommended. We've seen corn go up and down, mainly down. A lot of work to get done on beans today, so I want to jump right into the recommendations. Let me go ahead and share the screen, and then we will go over the analysis behind this. So, in soybean, old crop beans, last harvest, we sold them, did a little re-ownership, stepped out of that, came back down, did a little more re-ownership. Now we're going to exit half of the Q4 24 soybean re-ownership in July contract. And we did the same after we made some Q1 sales on soybeans. It came down, we bought some, went down, bought some more. And so we're going to exit half of the Q1 25 soybean re-ownership contract. If you follow the recommendations, on average, your long position should be about 15 cents. We should be about 15 cents better than your average buy-in. So USDA report on Thursday, so give or take, right? It could be more or less than that. We'll see next week. But we are also going to sell 30% of our Q2 25 soybeans. The calendar is saying, hey, you're running out of Q2. You better get started selling. So it's time to start selling. We're going to sell 30% this week. And we are going to hedge 30% of our Q3 soybeans, use the September contract. We are also going to sell 20% of new crop beans. We are in the middle of the range where we've been working with cash prices, basis improvement. A lot of cash prices are actually better than what they've been, but we're right in the middle of the range. So why all of a sudden getting all this work done on soybeans? We've had opportunities similar to this before, and seasonality is a big part of it. So I want to go over that in the analysis. We'll come back to this at the end of the video when we do the summary, but let's go over just some real big picture analysis so we can understand a little bit of the thought process. So generally speaking, there's three big categories of indicators that we look for. The first one is seasonality. I'm going to talk about that a little bit right now. And then the next one is the position of the funds, speculators. And then the last one is just technical indicators that help us know, is it an uptrend? Is it downtrend? Is there support, resistance, all that stuff? So I wanted to quickly talk about seasonality because it's important to understand the difference between uncertainty and risk.
uncertainty is not knowing what's going to happen. I don't know what's going to happen in the markets. I don't have a crystal ball, neither do you. So uncertainty is unknown. Risk, we can measure actual risks of happening. So I wanted to draw just to kind of try to exemplify a little bit of the risks of markets, so it hopefully makes sense to you. If we think about the fall and we just look at average on-farm cash prices, basically in the fall we have weak Chicago Board of Trade price, typically speaking. There's exceptions to all this, but if you would take the average price over 30 years, so let's just say the average price over 30 years, it's typically weak in the fall. We start getting a little bit of a rally here into the winter, then it stays sideways. And then the springtime, we often get a big rally. And then on average in the summer, it starts coming down back to whatever the next fall price would be. That would be on average how prices fluctuate. If we were to draw a min-max around that, so the maximum average price and the minimum average price, right? We would have like 2012 where we had a very high price here. But then generally speaking, if you take out 2012, the min-max would work something like this. The max price would be something like that. And the min price would be something like this. Generally speaking, on average, you would have something like that. So part of the reason that spring prices are good is because you have the chance for that rally. What happens, and I should actually draw this a little bit better. What happens right around here, right? Part of the reason that that's typically a good time to sell is because you have not that much downside risk, and you have all the upside potential. Now into the summer, there is plenty of upside potential. Get green. There's plenty of upside potential. If you look at that. There's also plenty of downside risk, if you look at that. So that's just the average on-farm cash price. So how do you manage that, right? Well, being disciplined about selling in the spring is a big part of it. For reference, if we look at another way to handle this, and I do think it's important, let me just write in yellow. Yellow will be basis. So let me do yellow is basis. So all those other colors are average on-farm price. But if we look at basis, basis basically goes like this. It goes here, then it goes up, and then it goes sideways, and then it goes up, 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 up. And then it actually won't go up until harvest, right? It goes here, and then it goes sideways during the winter, and then it goes up, then it goes up some more, and then it tanks, coming into harvest. So what you have in the summer, and we're at the end here, what you have in the summer is you have the possibility of strong basis, actually the probability of strong basis. You might have good prices on the futures, but you have a significant amount of downside risk. What makes this year so hard on corn, and we'll talk about the corn market in a little bit, is that we are in spring, and I'm going to put this in red. We are in spring and we are close to harvest lows. So we're in spring and we're down here. So what do you do? What do you do with this, right? It's seasonally, it's saying we're going to absolutely get destroyed here. There's a lot of downside risk, but we're already down there. Like we're already close in price level to last harvest low. So that's tricky. Just wanted to give you a brief glance at seasonality, and then again we're going to talk about the pyramid. So we make a market plan portfolio. You can see this week we hit almost everything in that portfolio with soybean sales. The reason we were so proactive, or the recommendations are so there's so many recommendations on soybean sales, is because the seasonality is saying we're going to start having risk. So we have as much as uncertainty coming into the summer as we've ever had, but we do have significantly more risk, especially since corn is already down in the dumps. If we don't get a good report or don't survive Thursday's report, we might really take it in the chin in the bean market. And there's just significant risk. Not so much this week, but by the time June 30th rolls around, yeah, there's going to be significant risk on, the old adage, get your sales done by the 4th of July and whatnot. So there actually is risk to the downside that's pretty significant that we want to avoid. That doesn't mean there's not upside potential, but wanted to make sure we have that covered. So let's look at the markets. First, we'll look at soybeans, then we'll look at corn, and we want to summarize it. Okay, so soybean market. Let me get a marker, pull that up, and let's see what color would work. We'll do blue. Bam, there, blue. And pull this down. So the speculators, if they're above zero, that means they are long. So we still have speculators long, but they reduced their long position. So not really a ton to write home about. Speculators are about where they have been. They're not long enough to say, hey, you got to sell because they're long, but they're also not short. So there's just not much of a story there that's any different than what we've seen the last several weeks. If we look at kind of the technicals of the bean market, this first one is the July contract. July contract actually is in an uptrend above this 20-day moving average. That's that blue line. This blue line here is the 20-day moving average. So beans actually are in an uptrend there. That's good news, but that's about the only contract that is showing this strength. So if we can be hopeful, right? We can say, hey, I think beans are really going to get a rally. But even if they do get a rally, how much of a rally will they get? Can we move up to $11? Maybe. Seasonality for the July contract, we really only have about 2 weeks. So yeah, we could get a friendly report on Thursday. We could get a nice little rally. We could rally 30, 40 cents. We could rally $1. Fine. But we're running out of calendar. We're running out of runway. And if this falls over, it's going to be increasingly hard to rebound. So that's why we're not getting out of all of our long positions. We're not selling all of our beans, but we are basically, unless something drastic happens, probably between now and the 30th of June, our bean sales are going to be basically, a lot of them are going to be done, right? Unless something drastic happens. And let's look at some new crop. New crop is a similar story. It's right at the 200-day moving average, which means the bean price is right in line with the average of basically the last year. But it's not. It's not the best or the worst price we've had. If you look at some cash prices on old crop, the basis helps a little. On new crop, we're just right in the middle of the range. Why are we selling? Well, we're selling because we're in the middle of the range and the calendar is pressing up against us. Hopefully it goes up a little bit more and we can make sales later that are better. But we want to make sure we have some work on the books, and corn is not looking good and bean market is not really getting a rally. So we don't want to just wait forever, and we want to make sure we do get the work done that we need to get done, and calendar is saying get work done. So we're going to stay disciplined and get that done. Next, we want to shift gears and go to the corn market. And here for the corn market, let me get I think I'll do the green marker. There we go. Bam, green. All right. Speculators they have sold, and they have sold more corn. We aren't down to these sales levels down here that are huge, but we are over 100,000 contracts sold, and that is a significant selling position. It actually technically triggers our indicator as the corn market being oversold down here. And speculators, it's as if the corn market is excessively, oversold or artificially low. It can get worse. That's the bad news. They can keep selling, and seasonally, they likely would keep selling. Well, let me just say the bears and the bulls, okay? So the bears, seasonally, it's a sell. speculators can sell more, and why would they bet in favor of this year's crop when there's even more rain forecasted? Planting was great. Everything's perfect, so to speak, right? That's the bearish take. Speculators are going to sell more. Seasonally, they're going to sell more. And hold your horses. Corn is really going to get just destroyed. That's the really bearish take. What's the bullish take? How bad can it get? We're already at harvest lows from last year. Yeah, nothing's happened yet, but the crop's not guaranteed. Crop's not raised. Speculators are on the wrong side of the market. We get any little hiccup in this corn market, and in the field, and we could get a nice little rally. Also, low prices cure low prices, so we surely will see some demand come in here. Surely exports will be a little better than expected, and we'll start seeing something friendly out of this corn market. It doesn't take much if you're at harvest lows to get you a little bump coming into the summer. So yeah, it'll turn around. And this is a really tough situation for me because if you follow along, seasonality is a big part of keeping me disciplined. But the two indicators, which is the technicals and the position of the funds, are actually saying this is a buy. So for one more week on the corn, we're still staying on the sidelines. But the corn market is alarming, to say the least. And this is just what that looks like on a chart. I said we're close to last year's harvest lows. So let's look. This is July corn futures. Last September, that's where we were trading, and we're right back here again. A technical bad sign is that there is this mark here on the July contract. Yesterday's session, Monday's session, is what's called a key reversal. We've had a number of key reversals down. I'm trying to think what the last one was. What's a key reversal? When you have the candle, right? So in the same trading session, you trade higher than the previous session's high, you trade lower than the previous session's low. And if you're in an uptrend, a key reversal would be you close low. If you're in a downtrend, the key reversal would be you close high. So you take out the extremes of the previous day's session, and then you close in the opposite direction of what the market's been trading. So we started getting a little bit of a bounce, took out the high, took out the low, closed down. That's a key reversal down. But again, the issue is how low can you go? Our farmers, we're talking about sales that on a cash market there's on most markets, they're going to be sub $4 sales. Do farmers really sell at that? Is that, you say, well, let me get in line and make sure I get some corn priced under $4. Maybe this is back in 2016, 2017 pricing when $4 was a steal, but I'm not sure that in June farmers are too excited about it. It's unusual to have prices similar to harvest lows in June, but that's what we have. So we have to deal with. And then this is new crop corn, and new crop corn is actually a little bit interesting because we haven't been able to fall back to the prices that we had back in the fall. So if you look at in the fall and then again in the winter, the lows were down there. Well, we've hit this price range here. This will be the third time, and the market is not going below that. That's not to say it won't. It can, right? But on new crop, we haven't even been able to trade that low. For what it's worth, September corn is actually traded lower than, so September 25 corn is lower than it was back in September of last year. So it's a weak corn market. There's no way to sugarcoat it. Not looking good. But again, we also have rain forecasted, good planting conditions, and everything expected is positive. So positive for the crop, bad for prices. So we have a couple of headlines. Let me close this down before we summarize it. A couple of headlines to just go over, just a couple of dates to remember. Thursday, 12th, USDA report. That's the monthly report. The biggest report this month is June 30th. And that's just kind of it's quarterly stocks and planting numbers. Also, for I think this will be the third or fourth year that we've had the June 19th holiday. So it's just one session less in the middle of this late June. Two USDA reports to digest. Sometimes a seasonal scare. We're not really getting that seasonal factor, and one trading session less in the middle of that. So it basically between the middle of June report and the June 30th report, and you take one extra trading session out, a lot of times there's some fireworks that come. It's not looking like that's going to be this case this year, or maybe just downward pressure, but we just have to be mindful. Seasonally speaking, this is the big leagues. Maybe it won't be this year, but seasonally speaking, we have to be mindful of a lot can happen and a lot can change very quickly in this market. So let's wrap it up with a summary of the market. There we go. Okay. So corn seasonally is a sell. The spec funds in corn, they are sold, and they are sold down to a level that it justifies buying. So they are oversold on corn. The trend for corn is down. So basically two of the three indicators on corn would say buy. Seasonally, it would say sell. On the beans, we have seasonally, it is a sell. Managed money is long in the bean market, but not enough to justify selling. And I'm actually going to put the trend as neutral because it depends contract by contract. Some are in uptrends, some are in downtrends, but we're right there. There's not a clear direction on the bean market. So we're going to say, sell, neutral. Corn would lean towards buying by the indicators, and beans would lean towards selling because of seasonality and because of risk. The probability that we have a bad bad pricing in the summer, we're going to get a lot of work done in the bean market. And in many cases, it's not what we wanted from the market, but our strategies are in line with, we could have maybe done a little better, but it's pretty solid. Basically, it's worked, right? The strategies have worked in beans, and we're going to follow through with those. The reownership work, the being patient, we have very similar prices to what we have been offered on the cash side. So basis. Basis levels in the Eastern Corn Belt continue better than historic averages. And in many parts of the Western Corn Belt, basis levels are aligned with historic averages. We have a green light to sell on the cash market from basis. Inventories sold stored into the summer for soybeans should be associated with a basis strategy, not only a flat cash price strategy. Which is exactly what we did, right? Our summer bushels, we're saying, hey, hedge it, lock in the September price, but don't sell on the cash market. So I'll actually, let me take a minute and go back over that. I wanted to make sure this is clear. Let me see if I can get, this is the point that I wanted to emphasize. This third item there that I unmarked. The hedge 30% of quarter 3 25 soybeans use September. What we want to do is we're not going to deliver those in flat cash, sell them. We're going to lock in the September price. And what's the thought process behind that? If futures fall into the summer, which often they do, basis can continue to improve even more. So if you've locked in the futures and then the price goes away, that's fine. You could still get more out of the basis. So we want to lock in the futures on that September for summer bushels. If you have, those quarter 3, those summer bushels, we want to lock in the futures against the September contract, and then we will deliver the grain at a later time and lock in the basis at a later time. I guess you could do an HTA where you would already deliver the beans, but the idea is we lock in the futures, and then we're going to wait to get another basis push. If we get it into the summer in July and August, then we will sell on the cash market to hopefully get that last little bump up in basis, 10-15 cents more. So just wanted to make sure that's clear. Let me know if you have any questions. And then from a technical standpoint, the corn market is close to the lows from last harvest. This is seasonally unusual. Soybeans are right in line with their average price over the last 200 trading sessions. Maybe they can rally, but seasonally, if markets start falling, they don't always come back. Let me stop this. Seasonally, this is the big leagues, right? June is a month where I've seen all sorts of things happen. And this is one for the books, especially in the corn market. Seeing prices near harvest lows in June is unusual. But I guess it keeps us on our toes. The big takeaway is let's just be disciplined on the beans. Let's get the work done. Hopefully we get a friendly report, get a turnaround, but let's keep clipping away at work and on the sales work. We need to wrap up our sales on soybeans, and very likely we're going to get some work done on corn. Now, like we said, we do track the indicators. So 2 of 3 are saying it's a buy on corn. We're not going to lean too heavily into that on the selling side. And keeping an eye on all this. Report on Thursday, and we will touch base again next week. Let me know if you have any questions.